Right now, the market is in chaos. The Iran war just triggered the worst sell-off we've seen in years. Brent crude hit $120 a barrel. The Dow fell 4 weeks straight, its longest losing streak in 3 years. The S&P 500 dropped 4 consecutive red weeks. The Russell 2000 dropped into correction territory, down 10% from its January peak. And the VIX, Wall Street's fear gauge, surged 11%. Traders are panicking. Portfolios are bleeding. Social media is full of people screaming that the sky is falling. But here's what nobody is telling you. This has happened before, many times. And the traders who survive these moments, they don't predict what happens next. They don't try to time the bottom. They manage their psychology. Today I'm giving you 3 simple trading psychology steps that will protect you during any volatility event. War, pandemic, flash crash. It doesn't matter. These 3 steps work every single time. Let's get the facts straight. On February 28th, the US launched military strikes against Iran. Markets dropped immediately. Oil spiked 15% in the opening days. The International Energy Agency called it the greatest global energy security challenge in history. And that's not just rhetoric. 21% of the world's oil supply moves through the Strait of Hormuz. When that choke point is threatened, everything ripples. Energy, defense, airlines, shipping, consumer prices. There's no sector untouched. And individual traders, they're absorbing the worst of it, not because they picked the wrong trades, because they're making decisions while their nervous system is in overdrive. If you've been glued to the screen watching red candle after red candle, if you sold something last month that you genuinely believed in, tell me about it in the comments. No judgment. That awareness is where the turnaround starts. What the panic sellers don't realize is that the data tells a completely different story. Multiple Wall Street research firms have studied every major geopolitical shock since World War II. The finding? The S&P 500 gains an average of 8.4% in the 12 months that follow. 8.4. Wars, invasions, assassinations, terrorist attacks, all of them. The market processes the fear and then it moves forward. Not because the crisis doesn't matter, because markets are pricing mechanisms. They absorb bad news in hours, sometimes minutes. By the time you're reading the headline, the worst is already priced in. Selling at that moment means selling at peak fear. And peak fear almost never marks the real bottom of anything that matters long term. Ray Dalio framed it perfectly. He said, the biggest mistake investors make is assuming that what just happened is what will keep happening. War feels permanent when you're in it, but recoveries are already forming underneath the surface while everyone is still looking at the wreckage. Step 1. Cut your size, not your positions, your size. This is the most important thing you can do right now, and almost nobody does it. When volatility explodes, your normal position size becomes dangerous. A move that would normally cost you 1% of your account can suddenly cost you 3 or 4%. Because the ranges are bigger, the gaps are wider, the stops get blown through. Paul Tudor Jones has a rule he follows during every crisis. He cuts his position size in half immediately. Not because he's scared, because the math changes. If the VIX is at 30 instead of 15, the expected range of any trade just doubled. Your risk per trade needs to reflect that. So here's the practical move. Whatever your normal position size is, cut it to 50%. If you normally risk 1% per trade, risk 0.5%. Same strategy, same setups, half the size. You stay in the game. You keep your edge. And you don't blow up during a week when the market moves more than it normally moves in a month. Let me tell you what happened during COVID. March 2020, the S&P 500 dropped 34% in 23 trading days. The fastest bear market in history. Oil went negative, literally below zero. Traders who had normal position sizes got margin called, wiped out, accounts gone in days. But the traders who cut their size early, they survived the drawdown. And then they caught the recovery. The S&P rallied 68% from the March low to the end of the year. The traders who were still in the game, with smaller positions, rode that wave all the way up. The ones who blew up in March, they watched from the sidelines. This is not about being bearish or bullish. It's about being alive when the opportunity comes. And the opportunity always comes. Mark Douglas said something that applies perfectly here. He said, "The market can do anything at any time. If you truly accept that, then you size accordingly, not based on what you think will happen, based on what could happen." Step 2. Trade what you see, not what you fear. Right now, every headline is designed to make you afraid. Oil at $120. War escalation. Supply chain disruption. Inflation coming back. And your brain is doing exactly what it evolved to do, treating financial headlines like physical threats. Your amygdala fires. Cortisol floods your system. And suddenly you're not reading charts anymore. You're reading news and reacting. Here's what the best traders do during geopolitical chaos. They turn off the news. Literally. They close Twitter. They close CNN. They close Bloomberg. And they look at the chart. Just the chart. Price. Volume. Structure. That's it. The chart already contains the news. It already reflects the fear. The information is in the price. Your job is to read the price, not the headline. What setups are forming? Where is support? Where is resistance? Is there a trade here or not? If not, sit in cash. That's a position too. One of the most powerful ones you can take. There's a concept in behavioral finance called the availability heuristic. It means your brain overweights information that's easy to recall. And what's easy to recall? Whatever is on every screen, every headline, every notification on your phone. War footage, red candles, oil price tickers. Your brain sees this constant stream of negative input and concludes, the world is ending. Markets will never recover. I should sell everything. But zoom out. During the Gulf War in '91, the S&P dropped 18% after Iraq invaded Kuwait and recovered all of it within months. After 9/11, one of the darkest days in American history, the market recovered within about a month. The 2008 financial crisis, the deepest crash in a generation, full recovery in 4 years. Even COVID, 34% down to new all-time highs in less than 6 months. The pattern doesn't guarantee the future, but it tells you something powerful about what markets do after fear peaks. They climb, not because the problems disappear, but because prices already reflected the worst-case scenario and reality turned out to be less catastrophic than the fear priced in. I want to be clear about something. I'm not telling you to ignore what's happening in Iran. I'm telling you to separate the information from the emotion. There's a difference between understanding that oil spiked to $120 and panicking about it. One is data, the other is a threat response. Ed Sykota, one of the legendary trend followers and market wizards, boiled all of trading down to one principle: cutting losses, and cutting losses. Not predicting the war. Not guessing what the Fed does about inflation. Not figuring out whether Iran escalates or backs down. Just managing risk. Your job during a crisis is never to be right about the crisis. It's to stay in the game while others are knocking themselves out. How are you handling this volatility? Trading through it or stepping back? Tell me in the comments. This community always has a perspective worth hearing. Step 3. Have a crisis playbook before the crisis. This is the one that separates amateurs from professionals. Every elite trader I've studied has a written plan for exactly this scenario. Not a general trading plan, a crisis-specific plan. And it's written in advance. When things are calm. When System 2, the rational part of your brain, is still in charge. The playbook answers these questions. At what VIX level do I cut my size? Answer that now. What percentage drawdown triggers me to go flat? Decide now. Which positions do I keep and which do I cut in a liquidity crisis? Decide now. How long do I stay away from screens after a big loss? Decide now. When the bonds are dropping and the market is in free fall, you don't want to be making these decisions in real time. You want to open a document, read the rules you already wrote, and execute. No thinking, no debating. Just following the plan you made when you were calm. Here's a real example. During the 2020 COVID crash, traders with a playbook had rules like, if the VIX crosses 40, cut all positions to 25% size. If my account drops 10% from peak, go to cash for 48 hours. If I feel the urge to revenge trade after a loss, close the platform and go for a walk. Simple rules, written on a piece of paper. And the traders who follow those rules, they survive March. They caught April. They made their year. The traders without a playbook, they were glued to CNBC, making emotional decisions, selling at the bottom, buying at the top of a dead cat bounce, then selling again. A spiral of reactive trading driven by pure fear. If this is hitting home, subscribe. We go deep on trading psychology every week, and this community gets it. We're building something here for traders who want to trade with their brain, not against it. There's one more thing I want to leave you with, and this might be the most counterintuitive idea in this entire video. The best opportunities in trading almost always come from the moments that feel the worst. When Brent crude spiked during the Gulf War, energy traders who stayed disciplined made generational returns on the reversal. When the market crashed in 2008, Warren Buffett published his famous op-ed in the New York Times. The title? Buy American. I am. Everyone called him insane. He was buying into the worst financial crisis since the Great Depression. But he understood something that panic sellers never will. Extreme fear creates extreme mispricing. And extreme mispricing creates extreme opportunity. The Iran war will end. Every conflict does. Oil will normalize. Volatility will compress. And the traders who kept their composure, who followed their playbook, who stayed sized appropriately, they'll be positioned to capture the snapback that historically follows every single one of these events. That's not optimism. That's data. And data doesn't care about headlines. So here's where we land. The Iran war is real. The volatility is real. And the fear is absolutely real. But your response to it, that's the only thing you control. Step 1. Cut your size. Volatility expanded, so your risk per trade needs to contract. Same setups, half the exposure. Step 2. Trade the chart, not the feed. The price already absorbed the news before you read the headline. Let the candles guide you, not the anchors on cable news. Step 3. Follow your crisis playbook. If you don't have one, write it tonight while your head is clear. And remember, every major geopolitical shock in market history was followed by a recovery. Not some of them. All of them. The question is never whether the market bounces back. The question is whether you're still standing when it does. If something in this video shifted your perspective on what's happening, pass it along to someone who's panicking. They need to see this. Until next time, stay sharp, stay sized, stay in the game.